Hi, this is the 6th of November 2016. We've ended a pretty interesting week because, after a long time, we closed below the 20-week average. In fact, in September itself, we started breaking a couple of trend lines. But this average held importance because last year, even as the market was extending higher with multiple negative divergences, it kept holding on to this particular support and kept bouncing back to make one more new high and one more divergence for several months before the market actually gave up. So it was important to watch whether you actually get that break. And the last 2 months also involved getting intermarket divergences, which means that the mid cap index started to make new highs in late September to early October, which were not confirmed by the Nifty itself. And at that point of time, the Nifty was still showing signs that it was going to further weaken. So I maintained that stance at the start of October, but by late October, it appeared that the small cap index was still making new highs, and since the Nifty had already fallen in what looked like an ABC initial correction, I started to look for some kind of a counter trend move. Now we did get something, but it was particularly very small. I'm not sure if you'll get another one again. Maybe you will, maybe you won't, because this whole move down now has involved multiple gyrations, 200, 200 points on either side. But what you've made is lower tops and lower bottoms, and probably you'll see that pattern continue. But still, over the next couple of days, there's room for some more variation in the structure. So the short term could be a little awkward. Now, unfortunately, a lot of the moves recently are getting associated with global events. Just like in July, it ended up being Brexit, and now everyone's focused too much on what is a US election. And I say it's unfortunate because we are here sitting watching the Indian stock markets, and really, why should something, like an election in the US really be the focal center of what is going on? It wasn't the same in 2008, but it appears to be now happening that way. Probably because there's no other news for people to look up to. There's enough discussion that has happened on where the economy is headed, growth. You have statements coming out all the time on things moving ahead as expected, but the debate continues because numbers do not confirm in terms of credit growth or IIP, etc. And so you really wonder whether the numbers you're looking at are right. The hopes of earnings picking up by the second half of the year are also cooling off as people are coming to light with the idea that I was speaking months ago, that it's not going to be that straightforward. So we are through with all of that, and what has happened is we closed down for the month of September, and so far the last 6 months rally has essentially been three waves. We've really not completed an impulse, and when that move started itself, my sense was this is going to be an X wave. Definitely, I was not looking at these levels, but 7,600, 7,900, 8,200, those were the three potential targets, all of which got achieved and surpassed. And now we've reached 8,900, and still the entire rise is corrective as far as the Nifty is concerned. We've still not made a new high, and now you're broken, the weekly averages as well. So having done that, this week was interesting because the small cap index, which was the best performing index of the last 2 months, and was actually creating that final last intermarket divergence with the key indices, it formed an ending pattern and then fell sharply for the last 3 to 4 days, breaking the rising trend line all the way from Feb. So the rising trend line, channel line for the mid cap, small cap indices, which was still holding on, just broke this week with their tops occurring right around Diwali. So while the Nifty did not make what we would call a particular all-time high into the Diwali session, it probably made that minor high. But the indices that were really outperforming in terms of the broad market made those highs right then. So it does add to importance to the occurrence of that event, that probably the broad market has now given up as their key support levels have broken. Their weekly momentum has gone back from the buy to the sell side. So that's what we are looking at, and I wanted to really do a video, couple of over the last month or two to discuss what was my thought on especially one of the key macro drivers, which is the dollar. And the reason I wanted to discuss the dollar is that my sense was that it could start a major decline, and I've discussed both the alternates. One is the comparison with the 90s, where the initial dollar rally caused the crisis in a lot of the Asian markets, and then eventually it paused for a while, and then you had the second breakout on the dollar, which took it much higher. But the other thing to consider is that the dollar has also gone through this 7-8 year cycle, where it peaked in the early 80s, then it was falling for many years. Then again, it rose from 1992 all the way into 2001, and again, it was falling from there all the way into 2008, and then it's been rising from 2008 to 2015, which is a pretty long period. You have this 8 to 9 year kind of cycle in which the dollar is either rising or falling. You've really completed that cycle. And in that sense, at a 61% retracement of the previous fall, it was very much possible that the dollar actually stops rising. So now we've actually almost made a triple top for the dollar. We can still debate both ways, but for the short term, you're really headed to the lower end of the range again, forming what would be a triangle. The debate would be on whether the triangle is bullish or bearish, and I think you need to be open to both alternates, but I'm increasingly changing sides to the bearish stance. In fact, I'm taking it more strongly, similar to what I did in Jan. In Jan also, I thought that people were getting worried about events that have already happened, which is the falling crude prices, falling dollar, rising dollar, and so on. And those are the worries that were shaping the Jan and Feb market when commodities started to bottom, and many of the emerging markets actually bottomed and turned back. The Indian market continued to fall all the way into end of March, essentially because of our own events, which is the write-offs from the banking sector into the budget. But essentially, if we had correlated with the rest of the world, I think by by late Jan at least, you had the bottoms in many of those markets, and the dollar had started to fall by the second week of Jan itself. And so at that time, I looked at an ending pattern and discussed the possibility that the dollar goes into a major decline. By May, we'd seen one bottom in the dollar, and so we had to consider whether it would actually start rallying again, because the broad range had not broken. And from that sentiment extreme, we've seen a three-wave move up, and we're falling again. So the most probable course is that the dollar has started what would be a major decline, that many of the commodity bulls, the hyperinflationists were actually considering many years ago, but they were just early in the trend, and probably those signs show up. Of course, the final confirmation of this would come below the 91-92 level, but the setup in terms of the Elliott wave sense is increasingly favoring, I would say, higher probability to a dollar decline start rather than a top, rather than a bottom in the dollar. So that's my sense, and that is showing up in how you're seeing commodity prices behave. Of course, you make the exception for crude because that moved up recently on different reasons, and has been correcting from the $52 range. So it might tend to do something slightly different. But if you're looking at the base metals, if you're looking at the precious metals, especially basically the metal space, then they've been indicating for quite a while that the dollar would see a decline. Many of the other base metals, apart from copper, which was the weakest till now, which is zinc, aluminium, nickel, lead, all of them were actually holding out much more strongly. Copper remained down, forming a triangle at the base at $2 to $2.1 with multiple bottoms. There are almost four bottoms at the lower end of the triangle, and then it's broken out of that triangle this week by closing above $2.13. That was the breakout point, and it closed well above that, and now is into fresh move altogether. And same with precious metals. You had a deep correction, which I would call a wave 2 correction, and you probably started a third wave. And my sense was in last December that the ending diagonal that you saw in gold, an ending pattern or a triangle pattern like you see in copper, are essentially patterns that occur at the end of trends, and that is why that trend of falling commodity prices, which was true for the last 4 to 5 years, has most probably come to an end, and we've probably started the next leg higher. So the scenario that you're facing right now is that of rising commodity prices, a falling dollar, and falling equities. And the only last time you can think of that having happened in the last decade was in the first quarter of 2008, or rather the last quarter of 2007. US equities peaked in October. And for those who can't relate it, if you look at it on a chart, you'd see the dollar was actually falling from October all the way into March, April, and then it stayed down there, making multiple bottoms at that level till crude actually peaked all the way into June. And the dollar rally actually started only after June of 2008. So even though equities were in a bear market, you had a dollar decline. Now, how I read into that scenario is the dollar really reflects money flows, because you're into a free float currency environment, and what that essentially means is that it reflects money flowing into the US, which is why the dollar actually gets stronger. So it goes into US treasuries as a risk off trade, it goes into US equities as a risk on trade, and essentially it's been a long US assets trade, and which is why even though the US markets were holding up, you saw crashes in various other emerging markets, very similar to the scenario you had in the late 90s, the 1997 Southeast Asian crisis and so on. And that done, now that you're reversing course, essentially it means that money starts moving out of US related assets to other assets. Now, should that mean a bull market in other emerging markets like it did happen after 2001, 2002? It's debatable, but one of the signs was that commodity prices started to rise at that point of time, which essentially benefited the commodity producing countries. The only thing is, reasoning was different. You had a demand led environment. If you're able to create a demand led environment for commodities, then definitely it's a repeat of the same scenario. But if that's not the case, then it will end up being a monetary phenomena that will be the key driver of this entire move, which means that all the money that has been printed and created over the last decade, and the key measure, velocity of money, actually shoots up, and you start seeing some kind of a mild hyperinflationary environment. So which one of the two is it going to be? We'll know in a matter of time, because if you've been reading into what the IMF and others are recommending in the slow growth environment, is that governments around the world take the bait and start spending into what will be some form of fiscal stimulus, rather than monetary stimulus, and that would then be a demand led driver for what we are beginning to see in terms of rising commodity prices. So that could actually be a near-term positive trigger for emerging markets or commodity producing markets. But the only problem is that unlike before, the risk of inflation pushing up interest rates, and that causing its own problems, which are related to the bond market and all the debt that has been taken on by the emerging space, and the impact of that on equity markets, is something that you would have to weigh at the same time as you're weighing the benefits of having higher inflation. So that tightrope walk is the tricky part, which was probably non-existent to the degree that it does exist today in 2002. And therefore, whether you can make those same comparisons is one big question mark. Also, what you had is the secondary rally in the dollar when it actually broke out after 1998. And so that's the scenario that probably some people were building, extrapolating into the move that we saw over the last few years, that probably the dollar rally would continue, and US markets would continue to do well. So that's the alternate scenario. Like I said, that's the less probable scenario, but I really don't know. We would have to watch on what happens in terms of the fiscal side from the governments around the world once they are through with all these elections, and probably that's one reason why these elections are in focus, to see what policies are going to be undertaken once new governments come to power. And you have not just US but many other elections in Europe also getting staged. So the trends that are visible, at least on charts, are that of rising commodity prices. The drivers, like I said, would have to be weighed to understand its impact on equities, but that seems to be the biggest macro trend. But in the near term, because of the fears of, uh, whether it's elections or it's simply, let's not even say fears, but simply a slowdown in the economic activity that is causing earnings to not grow at the pace that people expected. Equity markets are beginning to somewhat correct. And our own markets, which have been very vibrant in terms of the mid cap, small cap activity, have seen serious cracks this week. Uh, uh, if What we would want to see is they're not just event related cracks, but they're really to do with weakness in the depth of the market itself. Purely looking at charts, that's what it looks like, but we would have to be prepared for some kind of news based volatility as the event, which is the US election, is right around the corner over the next week. So that's it from me right now. The sense right now still remains that equities continue to weaken, but you'll see a lot of gyrations on both sides. You could get 200, 300 point bounces, which could surprise at point of time, and then you could again get a sell-off, which would continue to see new lows. So the lower top, lower bottom formation would probably continue, but once the distribution patterns, initial patterns are complete, I think the structure would become more easy to really read into and verify, and then the targets that you'd set would be more clear and directional after that. So usually that's the third wave. Once you had the initial wave, the third wave is usually easier to decipher. So that's where we are. That's all of this update. Thanks.